thus far, we've covered issuing bonds, we've covered paying interest payments on bonds, and we've also covered if there is a discount or a premium, how to amortize that discount or premium away periodically until you get to the retirement date of the bond. So let's now account for the actual retirement of bonds. And bonds are commonly retired at maturity, which means we sold the bonds for a certain amount. They've been sitting on our books while we make interest payments over the life of the bond. The end date of the bond rolls around. Now we're responsible for paying back our bondholders the initial amount of principal that they paid to us. So in this case, Smart Touch Learning has $100,000 of 9% bonds that mature on December 31st, 2022 on their books. Let's assume that all interest has been paid and that this discount is fully amortized on this bond. What would be the journal entry to record the retirement of this bond? Well, it's the same as any journal entry to pay off a liability. You debit the liability and you credit cash for the amount that you are paying. In this case, it is the face value of the bond, which is $100,000. So it would debit bonds payable for $100,000 and credit cash for that same amount. Let's do another example here. On June 14th, Paradise Pets is going to retire $40,000 worth of 11% bonds that have become fully mature. They have paid all necessary interest, and the discount on these bonds has also been fully amortized, so they're on the books for a carrying amount equal to their face value, which is convenient for us because we need to pay off that face value, and we're going to do so by debiting bonds payable for face, which is $40,000 in this case, and crediting cash, because that's what we're sending out to our now former bondholders to pay off our debt to them for that same amount, $40,000. And the journal entry to retire mature bonds payable. And while it is common for bonds to be out there until they reach their maturity date, there are situations where companies can retire bonds before the maturity date, and that is called a call provision. So some bonds will be issued with a provision in there that says the company retains the right to pay off these bonds early at this specified price. Why would companies want to pay off debt before they have to? Because if they pay off their debts, they're no longer obligated to make future interest payments. So if companies have the free cash sitting around to pay off their bonds, they may as well get out of debt and therefore not have to make the rest of the series of interest payments in the future. So some bonds are callable bonds. This isn't a universal feature of all bonds. It's only a specific subset of bonds that are callable bonds. Here we'll say that on December 31st, 2018, Smart Touch Learning has $100,000 of bonds payable outstanding, and they have a remaining discount balance of $3,081. So what are they carrying these bonds for? Well, for a bond issued at a discount, you take the face value of the bond less the carrying amount of its discount for $3,081 here, giving a carrying amount in total of the bond of $96,919. Well, these bonds have a call price on them, if you will, of $95, which means the company can pay off these bonds early by paying 95% of their face value. So if they're going to pay 95% of $100,000, that's $95,000. And if they do so, what's happening here is our books are saying we are paying $95,000 to get out of $96,919 worth of debt. That's good for our company. We're getting out of debt cheaper than our books say we should, which means we are experiencing a gain. That is a positive thing for our company. We're having a gain of $1,919, the difference between the call price we have to pay to retire these bonds early and their carrying amount on our books. Well, how do we book that in a journal entry? Well, bonds payable has been on our books at face value, and it's going to stay there until we retire these bonds. Well, we're retiring these bonds, which means those bonds payable have to come off our books. We take them off our books by debiting our bonds payable account for the face value of $100,000. These bonds have an existing discount of $3,081. Discount on bonds payable has a normal debit balance. Well, we need to reduce it to zero when we retire these bonds because we're no longer going to have these bonds outstanding. So to reduce something with a debit balance to zero, you have to credit it for the same amount. So we're going to credit discount on bonds payable for $3,081. We just determined that we are experiencing a $1,919 gain on the retirement of these bonds. Gains are like revenues. They're typically recorded on the credit side. So we're going to credit that account for 1919. And then lastly, we're going to credit cash, reducing that account by the actual call price of the bonds. And if you'll recall, they were $100,000 bonds with a call price of $95, which means we need to pay $95,000 in cash to get out of this debt. And we're going to denote that we did so by crediting cash for $95,000 when we retire these bonds payable prior to their maturity. Let's do another example here. Paradise Pets has $10,000 of bonds payable outstanding at this time. The bonds currently have a carrying value of $9,300. Well, we know that carrying value is always equal to face value, either less the discount or plus the premium. In this case, since it's lower, it's a discount. How much discount do we have on our books? Well, it's the difference between our $10,000 face value and our $9,300 carrying amount. We are carrying a $700 discount at this time. Well, on April 1st, Paradise Pets can buy these bonds back from the open market at a bond price or call price of $92, which means they can retire them early for 92% of their face value. Well, what is 92% of the $10,000 face value? It's $9,200. Well, our books are saying that we owe $9,300. So if we pay $9,200 to get out of the debt, we're getting out for $100 less than our books say we are indebted for, and that is a gain. So we have a gain on the retirement of these bonds of $100. In our journal entry, the first thing we need to do is take the bonds off the books for their face value by debiting them. So we're going to debit bonds payable for $10,000. Next, we're going to remove the discount from the books. And discount on bonds payable, having a normal debit balance, needs to be credited for its current balance, which we just determined is $700. We need to recognize a gain on the retirement of these bonds payable because we are paying less to get out of this debt than our books say we are indebted for. That's $100. And lastly, we need to record the payment of cash, which is always equal to the call price, in this case 92, times the face value of the bonds, $10,000. That's $9,200. And we retired our bonds payable prior to maturity. Let's do one more, this time where a company is paying more than their books say they are in debt for to retire bonds early. So Paradise Pets has $10,000 of bonds payable outstanding, and those bonds have a current carrying value of $9,300. Well, our discount, therefore, is still $700. On May 1st, they are buying these bonds back from the open market at a price of $95. So they can retire these bonds early by paying 95% of face value, and 95% of $10,000 is $9,500. Well, our carrying value is only $9,300. So our books say that we are in debt for $9,300, and we're paying $9,500 to get out. We are paying $200 more than our books say we are in debt for. How do we record this? Well, we start by debiting bonds payable for its face value, which is $10,000. Since we are paying more than our books say we are indebted for, we are experiencing a loss. And we're going to put that into loss on retirement of bonds payable. And losses work like expenses. They go up on the debit side. So that's going to be for $200. We need to take that discount off our books that's still sitting there, and that discount on bonds payable has a carrying amount of $700, we just determined. And then lastly, we need to record the payment of cash, which is always equal to the face value of the bond times its call price. $10,000 times 0.95 is $9,500 when we retired bonds payable for maturity. So when you retire bonds early, you need to always compare the price that you are paying to retire those bonds to what the carrying value of the bonds is currently on your books. If you are paying less than your books say the bonds are worth, well, then you're going to experience a gain. If you're paying more than your books say the bonds are worth at the time, well, then you're going to experience a loss.